Does it make sense to renew your mortgage with a 20-year amortization, or to extend that out to 25 years and take the money you're saving every month and put it down as extra principal payments? That's something someone asked me just the other day, and I had to think about it for a bit. Paying extra to the principal reduces your overall interest paid. Extending your amortization increases the overall interest paid. There are very valid scenarios where you'd want to extend your amortization, but in this particular case, you don't really come out ahead. Let's have a look at the numbers.
Okay, so let's look at a $500,000 mortgage over a 20-year term. I'm going to set the interest at 4%. The numbers don't really matter as much because we're looking at the comparison. So the monthly payments are going to be $3,021. Over the course of the term, you're going to pay $90,641 in principal and $90,633 in interest. That's over the 5 years. Total payment of $181,273.94. And if we go to the total over 20 years, you would pay $500,000 in principal and $225,000 in interest for a total of $729,095. Now let's set it back to the 25-year amortization. Let me bring in the numbers here too. And what we're going to do here is we're going to add on extra payments. So we're going to match up the payments. So we're going to add on an extra $391 a month. So the monthly payment is going to be the same. The monthly payment is going to be lower. We're going to do an extra payment of $391, and it knows it's almost 15% more. So the principal that you're going to be paying is $90,613 plus the extra payment of $23,460, which is a total of about $114,091. And the interest paid over that 5 years would be $90,634. Very similar actually to the other scenario. If we look at the total, your principal paid is $406,160 plus the extra payments of $93,840, which, look at that, is exactly $500,000, the same as in the first scenario. And the interest that you would have paid over this is $225,112.38, which is about $7-8 more than in the first scenario. And by doing those extra payments, you've actually brought the mortgage down to 20 years and 1 month instead of 25. So you're actually just a little bit behind because you have to pay it 1 month longer. But as you can see, the numbers basically don't really give you any benefit to do it this way. Where it would be of value is if you were going to pay extra in terms of monthly payments, not just the $391, but maybe you're going to pay $500 or $600 or $700 more. But you could also do that on the 20-year term.
If you have a specific scenario you'd like to run, come for a run with me and we'll work it out. Or shoot me an email, a DM, or give me a phone call.